Environmental, social and governance factors may long have been considered secondary factors in the investment process, but you only need to be reminded of what happened to WorldCom, BP and Lonmin to realize their importance. Graham Sinclair, principal of Synco, and Greg Barker from Sustainable Capital joins us from Cape Town to discuss these issues. And I'd like to start with you, Graham, first of all. Obviously, we're getting a sense from Greg around the work that they do on the continent. I wanted to see if you had a scorecard first for South African companies, which I think you alluded to in the first half of the show, and second to the general state of African companies and the awareness around ESG at this point in terms of disclosing these factors and making investors more comfortable with their setup.
Thanks, Warren. I think in terms of looking at South Africa first, definitely it's a very sophisticated environment. We know from the ongoing conversations about the BRICS Development Bank this week out of Durban, South Africa is pushing really, really hard to be host to that institution, partly leveraging the fact that they're a top five, South Africa is a top five market in terms of the quality of accounting and the financial standards, the great job the JSE has done around their listing requirements, the corporate governance work, the ESG work, and so on. So South Africa can operate at a fairly sophisticated high level, but that's not to say there aren't some skeletons in the cupboard or some things that have gone pear-shaped over the years. I think looking more broadly at Sub-Saharan Africa, the 20 African companies with more than $3 billion US in annual revenues. There's some pretty big African companies out there, but they tend to dominate their home markets, or in some, there's not the largest universe to work with. Now, when it comes to looking at them from an ESG perspective, I think there's a lot of work still to be done. We know that a number of the ESG rating shops have grown their universe of coverage, but I'd like to suggest it's kind of maybe first or second stage, perhaps on a seventh stage in terms of getting really sophisticated and really drilling down into the ESG factors at a company level and how those may or may not impact the ongoing license to operate of those companies, potentially impacting both headline risk and the bottom line itself.
Just turning to Greg, obviously, Greg, you're spending a lot of time looking at these companies and a lot of time consuming the information that they give you in terms of annual reports and disclosures they need to put through the stock exchange, et cetera, et cetera. What's the sort of state of disclosure for you at this point, speaking very broadly for companies on the continent? And I'd like to get your insight too on where you think if there's a particular area that disclosure can really improve.
I think the key factor is, and if you differentiate the rest of Africa from South Africa, is that gap between disclosure and reality can be quite wide. You've got, for example, companies which claim to be very progressive. They'll disclose a lot in terms of a flashy sustainability report. But when you drill down a bit and do some more detailed research, you find that the behavior is not in keeping with what they're saying. On the other hand, you've got some smaller companies which are flying below the radar screen ahead of best international practice. And I think that's the challenge for us as asset managers, or for Graham, who's trying to measure true sustainability of the underlying company, is that you cannot rely on that disclosure as your sole source of information. It's all very well to use that as a starting point, but if you're not actually checking that disclosure reflects the true position on the ground, you've got a major problem. What's interesting about Africa, outside of South Africa, is that those differences in sustainability performance are often totally mispriced. So you can have a wide deviation in the quality of the company, whether you measure it by earnings quality, asset quality, environmental, social governance factors, corporate governance, but it can be totally mispriced in the stock market.
Graham, just coming back to you there, obviously, we've got, you've been very involved in pushing institutional investors to make use of these things and to invest in companies, reward, if you could call it that, companies that have very good practices with regards to ESG. But where is the pressure coming from the companies themselves to not only up their game with regards to ESG factors, but also improve their disclosure of what's going on?
I think the institutional investors themselves have been very, very influential. If you look at something like the Carbon Disclosure Project, South Africa as a market has been covered for 7-8 years now as part of that overall project. It's been running about 11 years. You've got the whole foundation for that approach was to look to the institutional investors, $87 trillion in this last iteration, that had frank questions to ask of companies. What is your carbon footprint? How are you measuring it? Scopes 1, 2, and 3. And two interesting points. One is the Asset Owners Disclosure Project has built off the back of that approach, where now there's actually a not-for-profit driven partly out of Australia, soon to be registered out of the US. They are looking at asset owners, what they're saying and what they're actually doing. And actually the Government Employees Pension Fund did really well recently in a ranking or an index that they created around, well, what are asset owners saying at policy level? What are they actually doing? And the GPF, I think, was rated second. A second quick point I'd make is last Tuesday, Cinco was pleased to be part of the global team that launched the Access to Nutrition Index. It's a project that we've been building for 4 years or so. And what we're looking to do is target nutrition, both undernutrition and obesity in the food and beverage sector, and looking at, hey, you've got these companies, they're providing food stuff, so these are food manufacturers, large names, Nestle, Unilever, Danone, and so on. But what are they doing about making sure their food is available to people at the bottom end of the pyramid, so to speak? And what are they doing about making sure that the ingredients in those foods are actually nutritious for the people that are buying them? So there is absolutely pressure coming from institutional investors, but there are also other stakeholders who are looking at these issues on a kind of a long-term cycle and saying, where can we get companies to compete over the next decade that draws them in a positive direction?
Graham, I mean, just to get to that issue, obviously there's a great amount of influence that institutional investors can wield, but how far should we be going? I mean, do we really need to make sure that the companies that we're investing in have wholesome foods, or that are, I take the point that food should be safe, but I mean, are they healthy? Are they, are we not pushing this issue a little bit too far on issues like this without detracting from the investment process?
Sure. Look, Warren, I mean, there's kind of, when I group people and I talk them through, hey, there's ESG in every investment decision. Where does it show up in your investment architecture? People kind of break down into two groups. One is where they're thinking, yeah, you know, I'm looking at these, I need to proactively put them in there. And the others who say, you know, I don't really care unless something blows up, and then I care a whole lot about it, right? Why is there such a hoo-ha about the electricity price that BHP Billiton is paying right now? Why was there so much excitement around horse meat in Europe, or as we came to find out, water buffalo or beef in our so-called game biltong that we're meant to be enjoying? People are very nervous, for example, in the food sector about what they're eating. They want to trust the brands, and leading brands are getting this right. They're saying, you can trust us because what's on the label and what's in the product is good for you. We're here to sell you not just stuff we can sell you to make sure that you have food in your tummy, but we're making sure we're part of kind of your wellness and your health. Now, it's not the job of an investor to be a police person. I would say it's the job of an investor to make sure you're on the front end of a curve or a segment that's growing. There's no doubt that nutrition as a theme in the food and beverage sector is growing. And just looking at Coca-Cola's own breakout between their soda beverages and their growth in their non-soda beverages over the last 3 years, you just look at the numbers, it tells the story.
Greg, just to come back to you now, I know we're running out of time here, so I'd appreciate it if we could just be fairly brief in your response. But obviously, Graham's alluded to this pressure that institutional investors are placing on companies throughout the world around some of these factors. Do you get involved in a dialogue with companies where you see a shortcoming, either in disclosure or on an issue, that you just point out to them, or just calmly kind of try and tell them, we'd expect this to be a little bit better? Is it worthwhile in your process?
Absolutely. No, we actively engage with the senior management team and the boards of companies where we have material overweight positions. And because we believe that good sustainability practices are mutually inclusive with shareholder value, we actually believe that's part of our fiduciary responsibility. So as we help them to improve their practices and their behavior, we unlock value for our fund investors.